Bridging is essentially a short-term loan that the banks will give you to either liquidate some equity that you've got in a property, or even access money that you can't afford to borrow, but you can prove you can clear when you sell a home. So the whole idea of bridging is to get you from your current home to your new home as easy as possible. And typically that means buying a new home before you've sold. Now, a few things to keep in mind with bridging is that it's quite expensive. The interest rate is much higher than a regular loan, and we'll talk about that a little bit later on. But one thing that we also want to get across is that bridging can act in a few different ways. Some banks will charge you the bridging interest every single month, and you have to prove that you can afford to cover that cost. Others will just put that bridging interest on top of the bridging loan, so it gets bigger and bigger and bigger, and you've got a higher debt to clear when you eventually sell. And that's the example we're going to be using today, where the bridging debt gets bigger and bigger the longer that you've got the loan for. The main benefit of bridging ties into the purpose of bridging, to get you from current property to the next property without having to sell first. So the benefit is that it gives you time and it gives you convenience. You can find the perfect home, move in, and then focus on selling your property after. Now, bridging is only a 1 day to 12-month period, so you don't have forever to do this, but it does give you that flexibility to be able to move into the new home without worrying too much about where you're going to live if you've sold first. It means moving a family, moving into state becomes a lot easier than having to settle on the same day or sell first and find somewhere else to live. So that's the biggest benefit with bridging. The other benefit that isn't utilized too often, and it's not the main purpose of bridging, but it could be to time the market or to allow you to renovate a property before you sell. If you think you could achieve a higher price, your agent thinks you could achieve a higher sale price from renovating or from doing some minor updates to the property you've already bought, this gives you that time to make those updates and then sell your home. And it just means that you might receive a higher sale price and end up in a better result in the long term. Same sort of thing with timing the market. Perhaps you've got a property, or perhaps you think your financial advisor thinks that the market is about to take a downturn, or maybe even an upturn. In either case, you're trying to time the market so that you purchase in the best case for yourself and sell in the best case for yourself to maximize your profits at the end of the day. The thing that we've got to keep in mind, especially in that situation with the renovating situation, is that you're trying to make more money, but bridging costs money every single month. And so if you're spending $5,000 in interest a month on bridging, are you going to be making that money plus some by waiting to renovate or waiting to try and time the market? Because bridging is a convenience loan, the interest rate is much, much higher. At the time of recording, interest rates are sitting anywhere, 6%, 6.2%, and bridging interest is sitting at about 6.8%, all the way up to about 9.5%. So it's very expensive compared to a regular loan. And that's why we only want to put this in place for a short period of time if we can. So interest is definitely the biggest expense when it comes to bridging. There are some other admin costs which most banks will charge, somewhere around $1,000, $1,500 for a bridging loan, but the main interest expense is that rate, much higher rate on the bridging debt. Let's go into an example of what a bridging loan is going to look like. Now you can see that we're starting here with a current property worth $850,000 and a loan of $300,000. And what we're planning to do here is purchase before we've sold. But the bridging period means that we have two properties. We have our current property and we have the new property, because we've bought before we've sold. We've settled on the purchase before we've settled on the sale. And we could have settled on the purchase 1 day before the sale. We could have settled on the purchase 12 months before the sale. But whatever that time frame is between 1 day and 12 months, that's the bridging period. Now, when you do have an existing property and you've got some equity available, maybe you want to access some cash so that you've got a deposit ready for the purchase. You can absolutely do that as well. So you might want to take out $60,000, a 5% deposit for this purchase price, and that will be accounted for within the bridging debt as well. That's all absolutely fine. But for this example, we've just got one loan and we are purchasing, we're not putting any cash, so we need to cover $1.2 million for the purchase price. We need to cover nearly $65,000 worth of costs, stamp duty, conveyancer charges, so on and so forth. We've got our existing loan of $300,000, and that gives us a total of 1.565. Now, we're splitting this into two pieces: the end debt, which is the debt you're allowed to have once you've sold, and the bridging debt, which is the debt that you're not allowed to keep forever. It's short term, it's temporary. So the bridging debt can be a maximum of 80% of the purchase price. So we're just running with that, $960,000. And the difference between the 1.565 and the 960 is going to be our bridging portion. They're $662,000 in this example. Now bridging, like I said, we're running with the example that this loan is just increasing every single month because we're not paying the interest on the bridging debt. We're adding the interest every single month. And so when we sell, assuming in 12 months time, we have nearly $662,000 that we need to clear from this $850,000 sale. So that's assuming the 12-month situation. Now, the reason I've got a big question mark here at the end result is because when you sell for $850,000, you've obviously got some equity left after you clear the $662,000 debt. So why do I need $960,000 when there's clearly a bit of a gap? And that's a really good question. Banks do put some buffers in place with bridging. Maybe you sell for a little bit less. Maybe the interest you have for 12 months, but you only think you're going to need it for one. That's going to change how much proceeds you have at the end of the day. So if we look at that now, you've sold for $850,000. You've got a total cost to clear of about $24,000 between agent fees, conveyancing, marketing. But what if you had no agent fees? What if these all change? And this bridging debt, we've got $662,000 that we're clearing, which in my example is assuming a 12-month bridging period. And it means that we've got $164,000 left over. Now, if you use that money to reduce the end debt, you're not borrowing $960, you're borrowing $795. So whilst you've been approved for this, you don't actually need it. Unless, of course, we want to spend that money. Maybe we're spending it on a pool or some savings, or we just need some new furniture. Don't worry about the dollar difference. Now we are actually needing the full end debt that we've been approved for because we've spent money on other things at the time of sale. But on the other side, what if the bridging debt wasn't 12 months? What if we only had this for 1 month? So all of a sudden, it's only $609 that we need to clear. Now we've got a lot of money left over. What if we only had it for 6 months? We've got somewhere in the middle. We end up with $193,000 surplus. The end debt does change depending on when you sell. And so bridging, like we said at the start, is more about convenience. It's making sure that you get from A to B as conveniently as possible. It's not about getting the numbers perfect, although we can account for what the end result should look like depending on how long you have bridging. We can run all of those scenarios and tell you what it looks like in different situations. But this is a good example of knowing, or a good way to find out, whilst I'm being given a $960,000 loan, I don't want a debt that high. Therefore, I need to sell within 3 months, within 6 months. I've been given 12, but I really need to sell much faster. Or I really need to reduce the purchase price when I start looking so that I don't end up with a debt much higher than I'm comfortable with. So whilst this is a very rudimentary example of what bridging looks like, there's much more that goes into it. Not all banks will consider bridging. Not all banks will let you refinance away from that bank to them to do the bridging. They want you to be an existing client first. Some banks are charging, at the time of recording, 6.8%. Some are charging 9.5%. Some will allow bridging for construction. Some won't allow bridging for construction. Some only allow 1 month if that's all of the income that you can prove you can afford, or all the cash that you've got, you can afford 1 month worth of bridging interest rather than accumulating the interest over time. There's a lot of different ways to do this. And so you want a broker, you want a professional that's going to find the right lender for you, for the end debt, making sure that it's going to suit you in the long run, but also gets you the best deal for the bridging portion. And again, it's the most convenient thing for you. So make sure you reach out to your broker, reach out to me. We'd love to have a chat and make sure that this is the right structure for you.